Good morning, everyone. I'm Bernard Crespi from DataTel Payment Technologies. And this morning, we're going to explore how organizations can rethink the customer experience, improve workforce efficiency, and reduce operational risk through automation. We'll focus specifically on how organizations are managing phone payments today and examine how modern payment automation solutions such as IVR Payments help streamline operations, enhance the customer experience, and address the evolving needs of today's business environment. So let's get started. Now, every organization has a routine work that quietly consumes more capacity than leaders realize. And that's payment collections is one of those areas. On the surface, a customer calling to make a payment may seem like a simple transaction, but across a large organization, those transactions become a meaningful operational burden. They affect call volumes, they affect staffing models, they affect customer wait times, they affect compliance exposure, they impact revenue flow, and they influence how well the organization can scale without constantly adding more people and process. So for many businesses, the phone remains a critical customer channel. That is especially true in industries where customers may need fast access, may not be comfortable with online tools, or may simply prefer speaking or interacting with a staff member by phone. But the phone channel creates a challenge. If every routine payment requires a live employee, the organization is using its most expensive and limited resource, which is human attention, on work that may not require human judgment. And that is a leadership issue. Not whether customers can pay by phone. The better question is whether the organization has designed its payment operations intelligently. Are customers able to complete a simple task without any friction? Are employees focused on work that actually requires them? Is sensitive payment information being handled in the safest and most controlled ways possible? So, can the organization support more volume without adding cost at the same pace? That is the context for IVR payments. IVR payments matter because they help organizations redesign a routine but important customer interaction, making a payment by phone. The strategic value is not the automation itself. The value is what automation enables: better access, lower operational strain, stronger risk control, and a more scalable service model. Now, an IVR payment system allows customers to make a payment over the phone through an automated voice experience. But for business leaders, the definition should not stop there. An IVR payment system is a self-service channel for routine payment activity. It gives customers a familiar way to pay without requiring a live agent for every transaction. That distinction matters. Many organizations have invested heavily in digital tools, portals, apps, online forms, text notifications, and payment links. Those channels are important, but they do not serve every customer equally. Some customers still prefer the phone. Some may not trust an online portal. Some may not remember a password. Some may need to pay quickly while on their way away from the computer or their phone. Some may simply find the phone easier. So the question becomes, how does an organization preserve phone access without turning every phone-based payment into a staffing burden? And that is where IVR payments creates value. They allow the organization to keep the phone channel open while reducing the manual effort required to support it. This is not just a convenience feature, it's an operational model decision. A well-designed IVR payment solution allows routine payments to be handled consistently, securely, and at scale. It gives customers a practical path to completion while allowing employees to focus on more complex service needs. For executives, that is the key point. IVR payments are not about replacing customer service. They are about separating routine transactions from high-value human interactions. When the separation is done well, the business can improve service access, protect staff capacity, and reduce unnecessary friction in the payment process. Standalone takeaway: IVR payments help organizations provide phone-based payments access without forcing every routine transaction to go through a live staff member. Now, at a basic level, IVR payments are straightforward. A customer calls a payment number, the system guides them through prompts, the customer identifies their account, confirms payment details, enters the payment information, and receives a confirmation once the payment is complete. That is a customer journey. But the business value sits underneath that very simple experience. IVR payments move predictable, repeatable work into structured self-service process. That is important because routine work is one of the biggest drivers of operational inefficiency. A single payment call may not seem significant, but multiply that across thousands of customers, those calls can create staffing pressure, longer queues, higher service costs, and inconsistent customer experiences. The organization ends up using strained employees to perform repetitive tasks instead of using them where they add most value. IVR payments changes that flow of work. Instead of every payment call entering the same queues as a complex service issue, routine payments can be completed through an automated channel. Staff remain available for exception, for questions, for disputes, for escalation, and situations where human judgment is needed. That is better design. It does not eliminate the need for people, it protects their time. It does not remove the phone channel, it makes the phone channel more scalable. It does not force every customer into a digital portal. It gives customers another access path to payments. So for leaders, the point is not that the customer presses buttons or follows prompts. The point is that the organization has created a more efficient path for a routine demand. And this is what strong operating models do. They match the work to the right resource. Simple, repeatable tasks should be easy for customers to complete. Complex, sensitive, and emotional situations should be handled by people. So IVR Payments supports that balance. The takeaway here is that IVR payments work by moving routine payment activity into a guided self-service process, allowing employees to focus on much higher value customer needs. Now, when leaders hear PCI, they often think of compliance, but the larger issue is risk governance. Payment information is sensitive. Every time that information passes through people, through systems, recordings, screens, or manual workflows, the organization has more exposure to manage. That exposure creates operational complexity. Employees need training. Calls may need special handling. Recordings may need to be paused and protected. Processes must be monitored. Mistakes must be prevented. Controls must be documented. And the organization must be able to prove that sensitive information is being handled properly. This is not only a compliance burden, it's a management burden. So IVR payments can help reduce the burden by limiting how much employees directly handle sensitive credit card payment data. Instead of a customer reading a card information to a staff member, the customer enters payment details directly into an automated system. That can reduce employee exposure to credit card data and create a more controlled payment environment. The insight is simple. The safest data to manage is often the data your employees do not need to see, hear, or touch. This is where IVR payments becomes more of a payment than a payment channel. They become part of an organizational risk reduction strategy. And a better payment process can reduce avoidable exposure. It can simplify oversight. It can create more consistency. It can reduce variations across teams, and it can make the organization easier to govern. The goal is not only to comply with PCI requirements, the goal is to design operations in a way that reduces unnecessary risk before it has to be managed. And that is the important distinction. Compliance asks, are we meeting the standard? Leadership asks, have we designed a process in the fastest and most resilient way possible? So IVR Payments helps organizations move closer to that second question. Now, the takeaway here is IVR Payments can help reduce payment risk by limiting unnecessary employee exposure to sensitive payment data and creating a more controlled process. Now, this comparison between IVR Payments and live staff should not be framed as an automation versus people. That is too narrow. The better conversation is work design. Every organization has to decide which tasks should be handled by people and which tasks should be handled through self-service. Live staff are essential. They solve problems. They explain complex situations. They handle exceptions. They bring empathy into moments where customers may be confused, frustrated, or under pressure. But routine payment processes doesn't not always require that level of human involvement. When agents spend too much time talking standard payments, the organization creates a mismatch between the work and the resource. Highly capable people end up doing repetitive work. Customers with complex issues have to wait longer. Staffing models become harder to manage and cost rises as transaction volume grows. So IVR Payments helps correct that mismatch. They allow routine payment transactions to move into self-service channel, while agents focus on situations where they are truly needed. That creates value at several levels. For customers, it can mean faster payment completion and more convenient access. For employees, it can mean less repetitive work and more focus on problem solving. For operation leaders, it can mean better call flow, lower pressure during peak times, and improved service capacity. For financial leaders, it can mean a more efficient cost structure as payment volume increases. And this is the real advantage. IVR payments are not a replacement for agents. They are a way to protect agent capacity. That matters because workforce capacity is now a strategic issue. Hiring is expensive. Training takes time. Turnover is disruptive, and many service teams are already stretched. So organizations cannot afford to use human talent inefficiently. The strongest model is not fully human or fully automated. The strongest model uses automation for routine work and people for moments that require judgment, empathy, and trust. So here's a takeaway. IVR payments improve workforce efficiency by shifting routine transactions away from live staff to teams so that teams can focus on higher value customer interactions. Now, IVR payments are often discussed as a tool for specific industries, but the broader business pattern is much more important. Any organization that manages high volume of customer payments can benefit from rethinking how those payments are handled. The industry may look different, but the operating pressures are often very similar. Healthcare organizations need to collect patient balances while maintaining a sensitive and access customer experience. Utilities need to help customers make timely payments, often with urgency and high call volume. Insurance companies need reliable ways for policyholders to make premium payments and keep coverage active. Governments agencies need to collect taxes, fines, fees, permits, or other payments from broad in diverse populations, education institutions, for instance, and telecommunication providers and broadband, property managers, financial services field, and professional service organizations as well, all face very similar questions. How do we make payments easier for our customers? How do we reduce manual work for employees? How do we protect sensitive information? How do we collect revenue efficiently? How do we scale services without scaling the cost at the same rate? And that's why IVR payments should be viewed through an industry agnostic lens. The real qualification is not the industry label. It's the operating environment. Organizations should pay attention if they have high inbound payment call volumes, long wait times, limited after hours options, repetitive agent work, recurring billing activity, or unnecessary exposure to payment data. Those are signs that the payment process may be creating friction inside of the business. And that friction matters. It can slow cash flow. It can frustrate customers. It can increase labor costs. It can distract employees from higher value work. And it can add risk to processes that should be simple and controlled. And IVR payments are more valuable where payment activity is frequent, predictable, and important to organizations' revenue cycle. So in those environments, even a small improvement in process design can create meaningful operational benefits. So here's a takeaway for you. IVR payments can benefit any organization where routine payment calls create pressure on customers, on staff, on revenue flow, and on risk management. Now, the final question is not whether IVR payments are useful. The better question is whether the organization's current payment model is still fit for its purpose. Many payment processes were built around legacy assumptions. Customers would call during business hours, staff would answer, payments would be processed manually, service teams would absorb that workload. But customers' expectations have changed, labor markets have changed, risk expectations have changed, digital behavior has changed, and operating margins are under pressure in almost every industry. So leaders need to ask better questions. Are we using our people for the work that matters most? If trained employees are spending too much time on routine payments, the organization may be wasting capacity that could be used for more complex customer needs. Are we making it easy for customers to complete simple tasks? A payment should not be harder than it needs to be. Every unnecessary step can create delay, frustration, and additional service demands. And are your payment channels available when customers actually need them? Many customers do not think about payments only during office hours. A modern payment strategy should account for convenience, timing, and access. So the question is, are we exposing our organizations to avoidable risk? Sensitive payment data should not move through more people and more processes than necessary. Reducing exposure is one of the clearest ways to strengthen governance. So can our current model scale? If every increase in payment activity requires more staff, more calls, more training, and more oversight, the model may not be suitable. Are we designing around internal processes or around customer completion? This may be the most important question. Many organizations design payment processes around how the business is organized internally. But customers judge the experience by how easy it is to get something done. And that's why IVR payments deserve a strategic conversation. They're not just a phone payment. They are about how organizations handle routine demands in a way that is efficient, secure, accessible, and scalable. So for leaders, the opportunity is to step back and ask, where are we still using high-cost human effort for low-complexity work? Where are we creating friction that customers should not have to experience? Where are we managing risk that could be designed out in the process itself? Where are the questions that turn IVR payments from a technology discussion into a leadership discussion? Okay, we're going to repeat this whole section right now. And this is slide 8. So we're going to repeat slide 8 again. The final question is not whether IVR payments are useful. The better question is whether the organization's current payment model is still fit for purpose. Many payment processes were built around legacy assumptions. Customers would call during business hours. Agents would answer payments, would be processed manually. Service teams would absorb the workload. But customer expectations have changed. Labor markets have changed. Risk expectations have changed. Digital behavior has changed. And operating margins are under pressure in almost every industry. So leaders need to ask better questions. Are we using our people for the work that matters most? If trained employees are spending too much time on routine payments, the organization may be wasting capacity that could be used for more complex needs. Are we making it easy for customers to complete simple tasks? A payment should not be harder than it needs to be. Every unnecessary step can create delays, frustration, and additional service demands. So are payment channels available when customers actually need them? So many customers do not think about payments only during office hours. A modern payment strategy should account for convenience, timing, and access. Are we exposing our organizations to avoidable risk? Sensitive payment card data should not move through more people and more processes than necessary. So reducing exposure is one of the clearest paths to strengthening the security governance. Can our current model scale? If every increase in payment activity requires more staff, more calls, more training, and more oversight, the model may not be suitable. Are we designing around internal processes or around customer completion? And this may be the most important question. Many organizations design payment processes around how the business is organized internally, but customers judge the experience by how easy it is to get something done. And that is why IVR payments deserves a strategic conversation. They're not just about phone payments. They are about how organizations handle routine demands in a way that is efficient, secure, accessible, and scalable. So for leaders, the opportunity is to step back and ask, where are we still using high-cost human effort for low-complexity work? Where are we creating friction that customers should not have to experience? Where are we managing risks that could be designed outside of the process? Those are the questions that turn IVR payments from a technology discussion into a leadership discussion. And these are the takeaways. The strategic question is not whether a customer can pay by phone. It is whether an organization has designed payment operations to support scale, efficiency, access, and risk reduction. Now, the most effective organizations are not simply adding more tools. They are redesigning how work gets done. That is the bigger lesson behind IVR payments. At the surface, IVR payments allows customers to make payments by phone through an automated system. But at the leadership level, the value is broader. They help organizations improve customer access. They reduce pressure on live agents. They support more efficient revenue collection. They limit uncertainty, exposure to sensitive payment. Okay, we're going to repeat slide 9 now. The most effective organizations are not simply adding more tools. They're redesigning how work gets done. That is the bigger lesson behind IVR payments. At the surface, IVR payments allow customers to make payments by phone through an automated system. But at the leadership level, the value is broader. They help organizations improve customer access. They reduce pressure on live staff. They support more efficient revenue collection. They limit unnecessary exposure to sensitive payment data. And they create a service model that can scale more effectively and efficiently over time. And that's why the conversation belongs with executives, not only payment teams, because payments are not isolated transactions. They are moments where customers experience operational capacity, risk management, and revenue performance all intersect. When those moments are poorly designed, the business feels it. Customers wait longer. Employees spend time on repetitive tasks. Leaders carries more risk. Cost increases, and scaling becomes a lot harder than it needs to be. So when those moments are designed well, the organization becomes easier to operate. Customers have more ways to complete payments. Employees can focus on higher value work. Risk is easier to govern, and the business can handle more volume without creating the same level of strain. So the question for leaders is simple. Are your payment operations helping the business move faster, serve better, and scale smarter? Or are they quietly creating friction, cost, and risk? And that is the real value of rethinking IVR payments. So thank you everyone for your time and participation today. I hope the session has provided valuable insight into how payment automation can enhance the customer experience, improve operational efficiency, and reduce operational risk. If you have any questions or would like to discuss your organization's specific requirements, please don't hesitate to reach out. We'll be happy to continue the conversation and explore how we can help.